All right, so Elon Musk is trying to assure everybody that this price war is going to work out in the long term. Do you agree with him? If he continues to cut prices, will Tesla actually gain market share, especially with some more established competitors like Ford and GM trying to horn in on this market?
If you're a Tesla investor, then the next few minutes of this video may give you a reason to once again reevaluate your investment and assess what exactly it is you're investing in.
Do you have a price target on Tesla of $215? After yesterday's results, does that change at all?
It did. I slightly lowered my fair value estimate to 215 from 225 due to slightly lower margins that I was anticipating that will likely persist through 2023. When we saw the first quarter results, operating margins for the company, which CFO Zach Kirkhorn focuses on, fell to 11%. That was below where I thought they were going to be. I thought they were going to be at 13, 14% for the year, which was still a 2 to 3% compression from last year. But due to the price cuts and the ongoing price cuts, as Tesla did cut earlier this month, again, I think that we're likely to see lower margins persist throughout the year. But, you know, more importantly, if you look over the long term, I see really no changes in Tesla's story here. While they will be pursuing a volume over price strategy this year, while we see an economic slowdown, over the long term, the growth story is very much intact.
So yesterday we heard that the real key metric there was that gross auto margin of 20.5%. That was the estimate. The fact that it fell, a significant amount below that, do you see that as a long-term trend? Do you see that margin number continuing to decline? And how does that shape the narrative around this story?
I think over the long term, Tesla is likely to be able to get back to what the 29% automotive gross margin that they achieved over the past 2 years. We're likely to see that drop to the low 20% and remain there for this year and next year. But as they start ramping up new vehicles and as their cost reduction plans take hold that they detailed in the investor day earlier this year, I think we're likely to see margins expand over time.
Every big Tesla fan, in a way, nurtures an idea of what Tesla could be in the nearest future. The CEO of Tesla, Elon Musk, predicts that Tesla will one day be worth more than Apple and Saudi Aramco combined. Cathie Wood expects that Tesla will reach $2,000 in share prices by 2027, and Tesla bull Gary Black believes that Tesla's CyberTruck will be a game changer for the company. However, in all of this, there's still room for doubt, as no single company operates without having its own issues. Perhaps Tesla may be managing its issues pretty well, but this doesn't mean that it will continue to go smoothly. Hey guys, welcome back to Tesla Tomorrow. Tesla's stock price once again dropped below $200 after investors thought that things were starting to get better. The latest changes in Tesla's mode of operation in terms of pricing and deliveries has caused investors to question what exactly it is they're putting their money into. One aspect of which this question is becoming quite relevant is the recent drop in Tesla's profit margin. Although it was expected that the price cuts will drive up demand, profit margins are also getting affected, and many analysts are also thinking that probably Tesla is becoming the victim of this price war that it started. Could this be true? Let's find out. But before we start, if you like this type of content, hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Tesla recently raised US prices on 2 of its most expensive models, hours after shares fell following concerns that its aggressive price-cutting policy is eating into profits. The EV maker has been bringing down prices in the US this year in order to drive demand and help fill its factories in California, Texas, Germany, and Shanghai. This move has triggered fears of a broader price war in the electric vehicle market, putting pressure on the already thin profit margins that established car brands are making on their battery models. Some weeks ago, Tesla released its financial results and shareholders letter for the first quarter of 2023. The Wall Street consensus for this quarter was $23.617 billion in revenue and earnings of 85 cents per share. However, Tesla released its financial results and confirmed that it managed to meet expectations of 85 cents per share on earnings and missed on revenue by about $300 million. The automaker reported $23.3 billion in revenue in Q1 2023, down approximately $300 million from Wall Street's expectations, even though it did meet earnings expectations. The revenue figure for Q1 represents a slight dip from the $24.32 billion that Tesla reported in Q4, but still 24% higher than a year ago. On the profitability end, Tesla reported adjusted net income of $2.9 billion, less than the $3.03 billion estimate by the street, and $1 billion less than last quarter. Tesla's earnings showed that revenue stayed flat, with profit dipping, which could signify that the effect of margin compression could be at play here. But let's see what analysts have to say. Ryan Brinkman of JP Morgan has been wary of price cuts and their effects on Tesla's profitability, as well as other EV makers. The analyst stated that he's been cautious about the profit impact of Tesla's price cuts, writing that the lower prices are negative overall for Tesla, and less negative for traditional automakers like GM and Ford. This is because even though these companies are now likely to lose money in the interim on EVs, they have other profit centers to offset such losses. Pure-play battery electric automakers like Rivian, who are competing with Tesla, are even more likely to lose more money on EVs, and worst of all, it does not have profits elsewhere to offset these losses. Tesla's price cut strategy has prompted warnings from rivals. According to Renault, reducing prices damages the long-term residual values of vehicles that are used to determine leasing rates, and this will lead Tesla into a spiral. Thierry Piéton, finance boss of the French carmaker, states that there are no big incentives to go cut prices and kill the residuals, and also go into a spiral that some of the competition has done. No fewer than 7 analysts have lowered their price targets on Tesla shares. As of April 20th, Tesla stock has fallen 9.3% to $164.40, erasing $58 billion in market cap, an amount equal to more than 1/3 the valuation of Netflix. For one leading analyst, the sell-off isn't remotely big enough to bring Tesla's shares in line with its fundamentals. David Traynor, founder and CEO of investment research firm New Constructs, believes that using the most realistic projections for the likes of selling and earnings, Tesla is worth close to $28 a share. The analyst maintained that Tesla remains hugely overvalued, pointing to a $517 market cap. It still amounts to twice the combined valuations of Toyota and Volkswagen. Traynor is unswayed by the narrative that Tesla is not mainly a car company, but a tech company that will set the pace in self-driving vehicles and produce the next-generation batteries that its rivals will rely on. He believes that the flood of new, mostly bargain-priced models issued by every big competitor will substantially lower Tesla's profitability going forward. For Traynor, it's all about numbers. First, what Tesla's future earning must equal to justify its current cap. And second, assessing its true value based on reasonable projections for sales and profits. In a new report, Traynor gives his estimates showing that Tesla flunks on both criteria. Traynor's most likely scenario holds that Tesla will indeed get much bigger in the years ahead, but generate only slightly more profit than it books today. He believes that the big headwind will be the onslaught of low-priced EVs, vying for the same customers, and thinks it's probable that Tesla grows sales fast, at between 20 and 30% a year in 2023, 24, and 25, and at 10% in the 5 out years. While Tesla can remain a great company, Traynor argues that the stock, which is backed by strong logic, is headed for disaster. So, are price cuts going to be the downfall of Tesla? Let's hear what the automakers have to say. Tesla explained its pricing strategy in the shareholder letter, stating that its near-term pricing strategy considers a long-term view on per-vehicle probability and profitability given the future potential lifetime value of Tesla's vehicles through autonomy, supercharging, connectivity, and service. According to the automaker, it expects that its product pricing will continue to evolve, upwards or downwards, depending on a number of factors. Speaking on gross margin, Tesla said that although it implemented price reductions on many vehicle models across regions in the first quarter, its operating margins reduced at a manageable rate. It also added that it expects ongoing cost reduction of its vehicles, including improved production efficiency at its newest factories, lower logistical costs, and it's going to remain focused on operating leverage as the company scales. Tesla CEO Elon Musk also indicated the company was prepared to tolerate thinner profit margins in future to drive higher market share. According to Musk, Tesla is not starting a price war. The Tesla boss disclosed that the automaker is just lowering prices to enable affordability at scale. Tesla said overall revenue in the first 3 months of the year rose up to $23.3 billion, up 24% from a year ago as car sales increased. On a conference call discussing Tesla's earnings results, Musk said he thought pursuing increased sales with lower profits was the right choice for Tesla. Musk told investors that Tesla stands out among electric car makers for its profitability, adding that over the long term, profits would remain strong. Elon Musk also noted that Tesla's bottom line could be boosted after cars are sold using ongoing subscription payments for supercharging, self-driving, and other features. Musk believes that Tesla is still laying the groundwork and expects that the firm's profits is going to remain the highest in the industry. According to him, it's better for Tesla to ship a large number of cars at a lower margin and then subsequently harvest that margin in the future. RBC analyst Tom Narayan also shares these thoughts. He stated that in the long term, he believes Tesla's price cuts are the right strategy and leverages their cost leadership position, although this doesn't come without its pain as margins will likely get worse before they get better. Also, the biggest news could be the fact that Tesla managed to retain industry-leading gross margins on its automotive business despite the price cuts earlier this quarter. But what do you think? Let us know down below and let us know what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.